Hi everyone, welcome to this time Squarely Finance. Well, last week a lot of data was coming, which caused China's bonds market to have an obvious adjustment. The longer the bonds term is, the severe the adjustment happens. So, as always, let's have a quick review of the bonds market, then check out details part. Alright? Total bond yield curve kept twisted and steep compared to the week before. Yield of 3 years term down 0.7 basis points, and the yields of 5, 10, and 30 years terms went up 5, 6, and 8.7 basis points. If we compare to the one of December 9th last year, the curve was still twisted and flat. Yields of 3 and 5 years terms went up 2.5 and 1 basis point. 10 and 30 years terms went down 17 and 7 basis points. The spread between Chinese treasury bonds and commercial bank perpetual bonds enlarged, with 5-year spread was 51 basis points. About actions of investment agencies in last week for short and middle-term bonds, big banks and policy banks bought 132 billion yuan together. City commercial banks and joint stock banks sold 151 billion yuan together. And for long and ultra-long-term bonds, agricultural commercial banks bought 109 billion yuan, whereas funds, joint stock banks, and securities companies sold 128 billion yuan together. Next, let's check out details part and see what happened last week. In terms of fundamentals, first, financial data came out. For the financing part, the aggregate financing to the real economy was 1.16 trillion yuan, better than the same period of last year. And the net financing of government bonds was 1.24 trillion yuan, took the largest part of the financing. For the credit part, the new Chinese yuan loans was minus 0.5 trillion yuan, which was the first minus data after 2005, and of course worse than the same period of last year, in which household loans and loans to the enterprises and public institutions was still weak, which was a major reason that caused a minus number. Second, renminbi deposits was 0.5 trillion yuan, more than the same period of last year, minus 0.8 trillion yuan. The household deposits decreased a lot, whereas deposits of non-banking financial institutions increased. So we can conclude that the total social financing was still pilloried nearly all by the government investment. The private and corporate credit demand are still weak. Insufficient of effective demand is still out there. And thanks to the anti-convolution policy, the performance of the stocks market kept attractive, and more family deposits transferred to the capital market, which makes China's stocks market in a bullish vibe. Second, about economic data. Industrial added value, fixed asset investment, and total retail sales of consumer goods were 5.7%, 1.6%, and 3.7%, all worse than the previous ones. On the one hand, the anti-convolution policy pushes prices of industrial materials higher and restrains the industrial added value and fixed asset investment. On the other hand, the total resident disposable income has increased for now, which cools down the consumption demand. Talking all, the economy is now under a status of low-level inflation with weak demand for consumption and investment. So, from long and ultra-long-term view, although the reality of the weak fundamentals hasn't changed, which backs the long-term bonds, but the prospect of the economy probably recovering since now, plus the risky emotion rises in the capital market, the total vibe to the long and ultra-long-term bonds seem unfriendly. Thus, we should cut the duration of our portfolio. For funding condition, well, the total environment was good. For now, the report of second quarter MPC was released about monetary policy. It focuses on implementing existing policies and enhancing flexibility and foresight. Besides, it mentioned preventing funds from running idle again. So we say that the growth attitude of the PBOC to the bonds market kept loose and stable, but it will put eyes on where the funds go. So the price of financing may be more flexible than before. But now, the financing price is low, around 1.4% for overnight. So from short and middle terms view, the situation is safe and good. We can take it as a risk-avoid asset. You don't have to buy it more, but you must have it. What should we pay attention next? First, economic data, which is crucial to verify the recovery progress of the economy. Second, the Federal Reserve may cut 3 times this year, and the first one may happen in September. Does our PBOC follow the cut procedure? Well, it may cause another round of yields decreasing. Third, the stocks market. The SSE Composite Index almost hit 4,000, which definitely weakened the bonds market. So we don't fight against this trend. and say when this will stop. About bond investment strategies, now it's time to step in the yield curve for sure. The bonds market takes great pressure from stocks market and fundamentals, and the yield adjustment have been happening since last week, and now is far from the end. So it is safe and reasonable to make a bond yield curve step in the portfolio, cutting our long and ultra long term position, shrink our risk exposure and DV1, getting through this difficult period of time. So, as always, if you want to know more useful finance information about the Chinese bonds market and economic situation, please like, share, and subscribe. I will be always here, share my understanding and experience and waiting for you. So bye guys, until next time!